I would like to introduce our amazing facilitator for today's workshop, Alvin Lam. Alvin is a chartered accountant with over 13 years of experience in financial accounting. Previously, he's worked at Ernst& Young and provided financial leadership advisory to Fortune 1000 companies in the US. In 2018, Alvin joined Auxilium Financial Services as one of the founding team members. I believe he was one of the first four employees there, and since then has led the growth of the firm to a team of 36, providing full suite financial services to SMBs ranging from bookkeeping services to fractional CFO and everything in between. Alvin, we are super excited to have you here today, and I welcome you to please begin the session.
Awesome. Thanks, Elena. Hi, everyone. I'm just going to share my screen. Okay.
Perfect, we see your screen.
Oopsies. So I'm just trying to move the Zoom icon.
Yes.
Okay. Awesome. So hey, everyone. As Elena kind of mentioned, kind of want this session to be like a little bit interactive. So if you guys have any questions, feel free to just raise your hand and ask anytime throughout the presentation. I wasn't too sure about the audience base. So, Finance 101 is a pretty generic topic, call it. So I just kind of put in, a lot of information, and then we kind of dive deeper into certain things as, the session goes on, and kind of just choose from there. So, yeah, I won't go again. Like this is, I work for Auxilium Financial Services. You guys will have the deck, so I'm not going to dive deep into this. We're just kind of jump into the agenda for today. So for the agenda today, we're going to kind of go over, the financial framework, so the financial statements itself. Then we're going to jump into some of the accounting tools and softwares that I commonly see or some of our clients use as kind of how it helps them in their day-to-day, and kind of jump into kind of the details of those. Then we're going to move into kind of budgeting and more of the financial models. And then next, we're going to use those and kind of transition into, if you are a small business looking for funding, either through investors or through lenders, like what are some of the things that they're going to be looking for when you go present yourself and your company. And then the last part, we just kind of put it all together as to like, what's your funding presentation, what's going to be in your deck. And then, Q&A can be at the end or, throughout the session, however it kind of plays out. So to get started, let's talk about, I guess, the most exciting thing for accountants, the financial statements. We'll just kind of kick this off right now with a poll, probably like our first one, just to kind of gauge where everyone's at with their company and their financial statements. So if we just kind of put in the first poll question, pretty simple yes and no, is do you have updated financial statements for your last prior year? Okay, so it's like a 1/3 split. Some of you guys have it, 2/3 don't have them yet. Maybe it's not due. Okay, maybe we'll jump to the next one is, do you have updated financial statements for the last month? And I'm not saying like the ones that your accountants file, is do you internally have your monthly statements done for your prior month? Okay, so I think the results are pretty similar. It's kind of expected. I didn't expect a lot of people to have their monthly statements kind of done, but we'll kind of jump into the statements themselves, and I guess why they're important or why you should kind of pay attention to certain aspects of it. So starting off with so there's essentially three statements, in your financial statements. There's the balance sheet, the profit and loss statement, and then the cash flow statement. I'm just going to do a very high level of it. Essentially, it's great if you guys put it all together yourselves, but you can always work with other people to put it together for you. But even if somebody else prepares it, it's always good to have a good understanding of what kind of goes in it, so you can understand your business better. So, the major components of the balance sheet, there's obviously your assets, kind of broken up into two categories: your current assets, which is like defined as everything within a year. So like your cash, your receivables, hopefully it's received within a year, your inventory, any prepaid expenses. And then kind of your fixed assets, which is stuff that should, if all goes well, last longer than a year. It's going to bring your business benefit year over year for like, I don't know, 5 years, 10 years. I don't know, like your car or your equipment, office equipment, computers and whatnot. So that's like things you own, kind of go on the left side, your assets. And then on the right side of the balance sheet is kind of things the liabilities, whatever you owe. It's actually also both broken up into current and non-current. So your accounts payables, things you owe to your suppliers that are due within the year, any expenses and whatnot that are not paid. And then the fixed portion is kind of your long-term loan. And the last portion is kind of your equity, which is, your stock or your shares, whatever you sold. And the last part is kind of your retained earnings. So the only thing to remember, the balance sheet is a cumulative balance since your company's inception. So what I normally tell clients is, hey, if you're gonna make a mistake, just make it on the profit and loss statement, because next year you get a clean slate. If you make a mistake on the balance sheet, it does stay there until you clean it up or somebody helps you clean it up. And I have had situations where we were hired for a cleanup project or just to help them check their statements and whatnot. And the client, it was a professional services firm. They were very profit and loss focused for the past, 30 years. Never looked at the balance sheet. And then we looked at the balance sheet and realized they had, over $1 million of accounts receivable that, there's like 20 plus years old. They're never going to collect it. So you have to do a pretty big write-off for them and do a cleanup. So they ended up writing off like $1 million. So if accounts receivable is just because, they never looked at the balance sheet. They were dividing up all the profits between the partners purely on the profit and loss statement for like the past 20, 30 years. And, that didn't go well, the report when we presented it. So, do look at the balance sheet every once in a while. It doesn't go away until you, clear it up. So the income statement, or the profit and loss statement, this is pretty much an indication of how the company or how your business did in the prior 12 months, like the 12-month period. Like I mentioned, you kind of get a clean slate every new year. Everything starts at zero again. It's kind of broken down into your sales, which is your revenue, any cost of sales, and your gross profit. And then underneath that, it's all your expenses, your operating expenses. Essentially, you get to your income or loss for the year. Then you have your income tax line, and then it becomes your net income. The only thing I would say is for the profit and loss statement, it's better to keep it kind of simple. You don't want like 100 line items on this. You could internally for your own tracking, but for presentation purposes, it's always good to group them and classify them kind of in a easy to follow way. Like for example, like general and admin can just be that rather than having it broken down to like 15 different things you're actually tracking internally. You just kind of keep the detail, P&L kind of more internal. Okay. And then kind of the last, oh yeah. And then in terms of the classifications of your different expenses, so depending on how you classify it, will kind of determine if it ends up on the profit and loss or the balance sheet. Like for example, if you bought a computer, you can either expense it off right away in the same year, or you can put it on your balance sheet and it's like a fixed asset and whatnot. The key thing to reminder to kind of make sure is that you're kind of consistent as to how you classify things. If you bought a computer for like $500 or like $1,000 and you expensed it, but you bought an iPhone for also $1,000 and you put on the balance sheet as a fixed asset item, some people might ask you why you decided to do one or the other. So just make sure to kind of keep it consistent. It's just a lot easier to follow that. Okay. So the last one of the three statements would be the cash flow statement. I think from all the years I've been working with with small mid-sized businesses, this statement is not used very often or looked at very often, but actually, helps answer a very important question that I get asked a lot is, hey, my company was pretty profitable the last few months. Where'd all the money go? Right. So this statement explains that. Like, this is actually where the money went, because it kind of starts off as here's the profit that comes from the P&L on the first line. And then it kind of just makes adjustments that are kind of non-cash related. And it kind of breaks it down into.
Perfect. Yeah, I see a couple of questions in the chat. So Hassan is asking, when filing annual statement and tax filing, do we need to be a CPA?
No, you don't have to be a CPA to do the tax filing. It's just recommended that you have a CPA either review or check it and do the filing. I'm sure the guys at H&R Block are not CPAs. So there's no requirement for it, but it's always good to have somebody look at it and whatnot. And a lot of times, oh, by the way, I don't file taxes. I don't do income taxes or personal taxes. That's not something our firm provides. But so I'm not trying to sell myself, is what I'm saying. So, but it is good to have a CPA or income tax, professional look at your stuff. It's also for like tax planning between your business and your personal and all of that. So not a requirement, definitely recommended. I have a CPA that does my taxes. It's not myself, but definitely recommended.
Got it. And then Christine is asking, any thoughts on whether to capitalize incorporation costs on the balance sheet versus expensing them if they are less than 3K?
I've seen it done both ways. Some people capitalize their, incorporation costs, legal costs, everything in the initial setup. It just really depends on how material you think that will be to you over the next few years versus like keeping track of it. It really kind of depends. Like, oh, if I'm gonna make money in the first year, I'd rather just expense it out and reduce my income tax payable in the first year. If not, yeah, park it on the balance sheet, wait a couple of years, and then reduce your income tax payable then. So it's really a preference thing, but I've seen it done both ways. There's no hard rule against it because you can capitalize it.
Got it. And then Hassan has another question. If we have the government audit, do firms assist at that point?
Yeah, so we've done a lot of government audits, not for income, not for personal taxes, but for all of our clients. Like our clients get audited for payroll taxes, HST audits, income tax audits. Usually the firms that file the income tax, they would help with it, but it's really just correspondences. Hey, can you explain this? Can you provide receipts or invoices, explanations for this and that? So our firm does it as part of, the services. And yeah, same with payroll. Payroll, they would just ask you for remittance slips, like how, all of that stuff.
Okay, and on the topic of payrolls, Christine has a question. Would love to know more about doing our first hires in terms of payroll and income tax. Pros and cons of paying a first hire their gross pay and they handle their own taxes, or doing the tax deductions ourselves.
So normally how I've seen it is we would kind of do pay our employees the net amount and then kind of remit to the government. It's just kind of easier to set less liability that way because you also have to pay the employer portion anyways. So once you actually have a full-time employee, you have to pay the CPP and EI from the employer portion. So it's always good to just kind of do it, remit at the same time. Unless you're hiring them as a contractor, then that's a separate thing and you let them deal with it themselves. Obviously pros and cons of both.
Okay, and then there's another question. Do I charge taxes for customers in Canada only?
or well,
I'm guessing there are, are you talking about HST? Yeah. So, but before Alvin answers that question, because I know he's not like a tax accountant, but we do have a session on business taxes as well as part of
oh,
this workshop series. So hopefully a lot of your tax questions would be answered during that session as well. But Alvin, if you have anything to add to that, please go ahead.
yeah. So usually, like, well, HST is kind of there's a whole section in the CRA for it. It's more complex than we think. So the basic knowledge is yes, you're supposed to charge HST to, services in Canada, and not, I guess, to the States if you're selling to the States. And that's kind of the most simple answer. On the topic of HST, it's like if somebody charges you HST, the rule of thumb is there better be an HST number on their invoice or just don't pay it. Because the onus is on the person paying it to go check it. So if you bill me and charge me HST and I paid you and I go claim the ITC for it, and the government comes and audits me, and you actually didn't have HST number, it was my job to go online, check your HST number to make sure you're registered before I paid it, before I can claim my ITC. And I know that because of a HST audit I've done for the client before.
Awesome. Great. So we're all caught up with the questions in the chat, Alvin.
Oh, awesome.
Sorry, I just had a follow-up question there, Alana, and I wanted to ask Alvin. Thank you for answering my question earlier. I just wanted to follow up and ask if I don't have an employee in my company for my first year of operation, and I'm the sole kind of individual operating the business because I don't make enough to employ an intern or an employee yet. Would I need to file EI if I were to take out a salary for myself? And I mean, HST seems relatively simple. It's just at 13% on top of what I sell my service for, and then I just kind of send that over to the government. That's kind of my first question. Like, do I need to pay EI in that case? And secondly, if I don't hire an accountant and I do my tax and my annual filing for my business myself, and then later the government comes in, because that's kind of my only main concern, is that they would then kind of, I assume these processes can be lengthy and they can also be kind of very technical. In that situation, would it be best for me to employ a CPA or an advisor at that point?
I think if you're just really thinking about the individual question of where you should pay yourself as an employee or a contractor, I don't think you need to pay EI for yourself because if you own the business, you're not eligible for employment insurance.
Okay.
So I think that's not part of this. But if you were to pay yourself as a contractor and add HST to it, you would have to register like the business for HST number. I think that would be the only thing based on what you just said. Because I wouldn't know what the government would come back and review based on your filing. Like, because are you a sole proprietor or a corporation, like the company?
So I would be a corporation, but that you bring up a good point, which is if I pay somebody as a contractor, I'm eligible to claim HST on that.
Yes, if you paid a vendor like with HST, you can claim the ITC, but whoever you paid has to be registered with the government and have an eligible HST number, because they would then remit that HST. So essentially you claim, let's say $13, they pay $13, and it kind of nets up to zero, like for the government side.
No, I understand what you're saying. So, I mean, I guess it's just a way of thinking about it, is what you're saying. I need to think about it as, but I wouldn't be able to claim, I wouldn't need to make any EI payments if I'm taking a salary out myself, is what you're saying. And
If
then
you
number
own the
eight is,
company, yeah.
yeah, yes. Yes, sir. And then, so I guess for the second part, you recommend, just because it can get kind of expensive, are you recommending for the first year or two, not have like an advisor do your taxes or annual filings?
Well, you could, yeah, well, if your business is relatively simple and
Mhm.
you have a good set of records, which I'm going to recommend some tools in the next few slides where you just keep a good set of records. It doesn't matter who in the government's asking you what, you can pull it up right away. It's not really technical in that sense. Like they're going to ask you in a way, it's, oh, can you show me this or can you give me that? And then you can just pull up your QuickBooks or your Xero and oh, here it is. This is what this is for. And it would kind of be a process like that. It could be time consuming, but I don't think it would be complex. The issue is if you don't have a good set of books, that might be, it makes it a little bit more difficult.
Right. Yeah, makes sense. Thank you so much, Alvin.
Yeah, no problem.
Awesome, Alvin. In the interest of time, I think we can continue with the presentation. There are a few questions in the chat, but we can take them once you've covered more content.
Okay, yeah, sure, no problem. Yes, so this is the cash flow statement. Pretty sure most people like won't really use it in the beginning, but essentially tells you where the money in your company either came from or went to. It's kind of broken down into your operating activities, you know, investing activities, like if you buy equipment, you buy, you know, plant property equipment, all that is probably the most simple example. And then anything related to financing, like loans that you received or loans you paid back. And then at the end, it's that kind of shows you like this is your cash balance, and it kind of links back to your balance sheet cash balance. That's how kind of the three statements really link up together. Okay. So that was the wrap of the three statements. Not the most interesting thing in the world, but good to have some knowledge of it because you know it's best to know your business, even if somebody else is doing your books. It's good to know where things are. Moving on to some of the accounting tools that can help you accomplish this without having your CPA. Oh, there was. Okay, so some of the accounting tools that you know our clients use or that I know of are kind of the logos kind of listed out here. The ones we use the most is QuickBooks Online and Xero, and the reason is it actually just checks on the box that are in front of you. It's cloud-based, so my whole team can kind of log in. They can invite us as accountants. The client itself has their own login, so very easily traceable. And then it has like a lot of integrations for different applications and whatnot to make your life kind of easier. It's relatively user-friendly. They can also like have real-time connectivity to your banks. So instead of like you going to your bank, downloading a transaction, uploading it, they just kind of connect live. So that makes things a lot easier kind of for everybody. And they have, you know, pretty comprehensive reporting, a lot of automation that you can utilize, and they're relatively low cost. QuickBooks and Xero, they both have kind of like starter plans, you know, $5-10 a month, and then all the way to a more advanced plan that goes up to like $150 a month, and then anything in between. So just based on what you really need. So I guess, yeah, oh, Wave Accounting is something that I put in there because I know they're free. Out of all these I put together, I think they're the one that's still kind of completely free. I've never used them personally, but I know some clients that transition from Wave to another platform. And the last one, this is Excel and Google Sheet. This is kind of the last resort. If you really wanted to do your accounting and whatnot on your Excel, you could. It's better than having nothing at all, but it's called the last resort. So I mentioned like some of the tools that we use that integrate into QuickBooks or whatnot on your accounting platforms. The one we kind of use the most is called Dex and Float. And what it does is, I know a lot of the times it's, you know, you go about your day, you spend stuff on your business, you have a bunch of receipts. So the days of like sending your accountant a box of receipts are kind of over, and I'm glad for it. Because with Dex, you take a picture of it, and then the application just pulls all the data for you, and it goes into the platform and connects to your QuickBooks, and you know, classify it kind of then and there. So if you went out for, I don't know, a meal or whatever, you kind of take a picture of the receipt, it pulls the date, the amount, you know, the vendor, so the restaurant, and you can kind of classify the expense. So you call it meals and entertainment, networking, whatever it is. So it's about, you can kind of do it on the spot, so you kind of don't forget about it. And then it flows into your accounting system for you to review as well. So these are kind of like some of the things that we use it for. Float is another platform that does it. They're actually a fintech company. They started off as business credit cards, and then now they're moving more towards expense reporting and giving, you know, multiple people in your company access to having a virtual card, and have like a whole kind of approval process within their platform. And then Expensify is also, you know, an expense reporting tool. So all of these are, you know, tools that we kind of use. I recommend using some sort of tool. It doesn't have to be these ones. It's just a lot easier to track your day to day. And if you get invoices through email, you can just forward it to an inbox and it automatically populates for you as well. So it makes life a lot easier in that sense. And, you know, keeping a file folder or Google Cloud or something like that. And then lastly, I guess, payroll, since we kind of touched upon this. These are some of the tools that we use for our clients for payroll. Obviously, most people probably heard of ADP. They're a pretty big company, but they do have a TeamPay platform that is relatively cheap. You know, the benefits of using any payroll platform is that they help you remit the money to the CRA, like your employees portion and the employer portion. At the year end, they help you populate all the T4 forms for the company and employees. It's pretty easy to process the payroll. If you do have employees, they have their own login. They can go grab their own slips and whatnot. So it saves you on admin time. Most of them integrate with accounting software. If you have terminations, they also, most of them populate your record of employments for you, so you don't have to fill out the paper form. It just makes life quite a lot, you know, quite easy. So ADP is probably the bigger one. QuickBooks actually has their own payroll platform within QuickBooks Online. You just have to pay an additional fee for it monthly. Some of our clients use it, some don't. And then WagePoint is another relatively user-friendly payroll platform that some of our clients use as well. There are other ones, but these are probably the most common ones I've used. And then some of them actually, like ADP and some of the other ones, also have kind of an HR module linked to it. So when you want to track vacation days, and, you know, kind of promotions and all that stuff, those are kind of the additional portals that, you know, you can add on down the line. Okay. Okay. So that's kind of like the accounting tools. I know I kind of just like went by it pretty quickly, but is there any like question? I'm just saying, so if you guys use one of these tools, you guys would, you know, have your financial statements kind of done for you. If you just track your stuff in these tools, kind of ongoing, daily, weekly, whatever it is, at the end of the month, you have to do that quick check, make sure all the stuff in your bank is accounted for. And next time the poll question comes up, is your monthly financial statements updated for last month? It will be yes, because you have it in, I don't know, QuickBooks, Xero, FreshBooks, whatever it is. So that's kind of the purpose of this.
Question regarding the receipts. Do we need receipts for gas? What if we have a bank record but not a receipt, or we forgot to claim it?
You always quote, like, technically you always need receipts, but it's like a materiality thing. From personal experience, most HST audits ask you for your top 10. And unless your one specific gas receipt makes it to your top 10, it's very unlikely that they would ask you for the receipt on October 8th for your gas. So that's just from experience.
Thanks, Alan.
So if we have no questions about the tools and applications itself, we can kind of jump into kind of budgeting and your financial models. So, just to kick off is, oh yeah, I do have a poll question just to kind of see, if you guys have budgets and forecasts. I think it should be the third one. If not, then it's the fourth. Yes. So, how often do you guys update your budgets and your forecasts? Annually, monthly, or quarterly? Or trust me, it's my head. It's not really on paper, but I got it. Okay, well, that's a pretty even split. Okay, great. So most of you guys have an annual budget, or a monthly, quarterly budget is updated regularly, which is actually great. Let me get rid of this poll. So I'll kind of walk through, I'll kind of skip through why is budgeting important. This is for obvious reasons. Most of you guys already have a budget and you guys update it regularly. You don't have to go through that. If you guys all answer no, I don't have it, then we can spend a little bit more time on this. So the components of a budget, they're all a little bit different. More or less, it's really just your income, your expenses, fixed versus variable, whatever you have in your contingency funds, and then kind of forecast it out. So some of the things to kind of consider when you put together your first budget or you update your budget is it's a budget, it's an estimate, it's your best guess, but you always want to make it reliable. If you have historical information as a baseline, you kind of use that as your baseline and make your adjustments accordingly. You want to have what are the goals of the budget? Or we'll talk about it when we go into like the financial model or what investors are looking for. Your forecast should show the story you want to tell. That's what I usually say. But it also has to be realistic. So you don't want your revenue projections to be kind of like too good, because most of the time the investors are, what do you need us for? Or is this really realistic? You want to kind of make, and then also another thing is you want to make it like adjustable, or you want to be flexible with the budget. What I say is if you put the budget in Excel, you should have like kind of a separate tab where you put in your assumptions. You shouldn't like hard code the actual forecast, because if something changes, you have to go back and change, your 3 years or 4 years, 5 years manually, and it makes it kind of cumbersome. So those are kind of I would say are more important things to consider when you do the budget. Oh, sorry. Okay. So I kind of previously had touched on it. The elements of your financial model really is your revenue projection, linked in with your expenses forecast, and then your cash flow projection. Those are kind of the three main things that we normally have in part of your financial model. Oh yeah, I do have a poll question just to kind of see how much time we want to spend on the revenue side. If we can just pop that out.
That would be the last one, right?
Yes. So really it's like, I want to know if I want to spend any time on figuring out pricing, like you're developing a product, how much you charge for it and whatnot, because I actually didn't prepare that slide. Hopefully you all know kind of what you're charging for your products, what the market's appetite is for and whatnot. If not, we could spend a little bit of time on it as we kind of go along. Okay. So most of you guys, you know what you're selling your products for, different tiers, whatnot. So I won't spend the time on it. We can kind of jump into the revenue projections. So some of the inputs that we would kind of look at when you project your revenue would, obviously the number of customers or users you're kind of predicting. You obviously want to assume some sort of growth in that if it's reasonable. And then what is the average, revenue per user? And then if you have any different tiers of users, you will kind of map that in as well. And then the kind of like your sales volume. If you're selling a physical product, then like how much volume I plan on selling. Obviously there'll be like seasonality and all of that, but this is kind of like the main part to come back to your revenue line in your financial model. Depending on, I guess, your business, if there's like clearly identifiable like sectors or like departments, you would like kind of split it out and then come back to a total revenue, because that's kind of different. If you only like from ourselves at the firm, we split our revenue forecast based on projects and fixed monthly retainers, just because like those fluctuate differently, and that's why we forecast it differently. So it really kind of depends on your business. So some of the assumptions you kind of want to consider when you do your revenue is kind of obviously I kind of previously mentioned is your growth rate, what your annual growth rate is or month over month growth rate is, like different markets, or if there's existing competitors that may go into this market, how that would kind of affect the revenue. Any seasonality in your product. If you own a bunch of cottages or a bunch of ski resorts, that obviously should be reflected in your financial model when you do your revenue. And then number 4 is kind of important, is there is usually going to be churn. So in your revenue forecast to be realistic, you would have to kind of account for any churn in customers or clients and whatnot. And then the last part is, any like upsells or cross sells. It's like most of the time, if I get a client through the door, they buy this one thing, they'll most likely buy this thing on top of it. So that's just kind of something you want to put as assumption into the model if it's suitable for yourself, and then kind of put that in to kind of get your revenue number. And I kind of mentioned like you should probably put this like separately and not just calculate it on a calculator and add it in, because these things will change as you kind of go through the months and the years and you know your business better or you know the market better. It's always easier to go back and update one cell that populates throughout your whole entire model. Okay, you guys have any questions about kind of the revenue forecasting part? No, good. Awesome. Okay. So yeah, so for the expense side, you obviously have your fixed costs, rent, salaries for the most part would kind of be fixed. Doesn't really change month over month. And then your variable costs that, would change based on, the sales volume, your materials, your commissions and whatnot. So it's best to actually like split them out in your actual forecast. Some of the other, costs for the business to consider would kind of be what we listed up here, whatever your startup costs, if you wanted to either put that in your balance sheet or your P&L in your first year. Any operational costs, labor costs, taxes, we actually don't really put into the model. It's actually kind of a separate line item, because most investors or most lenders actually just ask you for your EBITDA, which is your earnings before interest, taxes, depreciation, and amortization, because they care more about how your business will be operating. So they kind of just want to look at the stuff that's operational and has a cash effect. So that's why that's usually what they would ask for. Another thing is for your financial models, you actually want to, if needed, there is a part where you can do some normalizations. Let's say you have like a one-off cost incurred this year. You can, just add it back, explain it. And, we had a closure for, 2 months due to this unforeseen expense, this unforeseen circumstance or whatnot, and it's not a recurring thing. You want to kind of highlight that, in the forecast itself as well. So that would be kind of like the expense side. So in terms of the expenses, some things that we normally look at, or a lot of people look at, is actually your client acquisition costs. So how much did it cost you to get one client into the door? So that's kind of the formula. So the cost itself really includes like, all your marketing costs, advertising costs, and whatnot. Some of the costs, like, when you sign up for, oh, there's a typo there, sorry about it. When you sign up for like, those free apps, it's not actually free for the company to give you the app. It's just a acquisition cost for them until you start paying for features. And that's just a cost you just have to assume. And they kind of do a calculation based on the conversion rate to see how many free customers will equal a paying customer, and then what is their lifetime value and how that kind of comes back into play. So that's like something that a lot of companies would actually look at is how much does it cost for me to get, a new member or a new customer or a new client like through the door. So this is like, as mentioned, it's kind of the ratio that a lot of people do look at is what is the lifetime value of this one customer versus how much it costed me to get that one customer through the door. So usually we would say a 3-to-1 ratio is a good ratio. If it's like below 1, it's not really sustainable because it indicates that you spent more money getting that customer through the door than they're going to bring you back. And then if it's above 1, it's a good thing. So try to aim for around like 3-to-1 is kind of the standard if you Googled it, but obviously it's different from different industries. But that is something that, we would kind of look at, especially if you're in tech, and you like, have a product or SaaS product. That's something that we would definitely look at. And then some of the common financial models, the ones I see the most, or the investors probably expect, would kind of be like the forecasting one where you have all your revenue, all your expenses, kind of forecasted for 3 years. And then if you incorporated some sensitivity to it, like a base case, best case, worst case, and it can kind of flip through like that to show all three within the same model, it will actually give you a better information or indication of your future performance. That would also be good. This cash burn model is a cash flow and burn model. It's something that, they're also after because they want to make sure you don't run out of cash before things come to fruition. Most of the businesses, when they do fail, is because they run out of cash. Usually it's a liquidity issue. So if you kind of account for that, or at least look at it and forecast that out, that would be something that would be very beneficial to yourself and to any potential investors or lenders kind of looking at giving you money essentially. And then that's what I just kind of put in there, the 3-statement model. I don't think most people expect the 3-statement model forecast. It's essentially just your profit and loss statement, balance sheet, and cash flow statement, but they all are linked together and they forecast it out. Most of the time when I work with clients in the early stages, they have a revenue forecast and a cash burn, and that's pretty good enough for all their presentations and to tell the story that they need to tell. So when you kind of put it all together, what if you were to go raise money to grow the business? You're looking for a loan, or you're looking for investors to kind of invest in the company. Like, what are they looking for? So there's a list of things that are kind of listed out of what they're looking for, but to summarize all this before we go into detail, what they're actually looking for is, will I get my money back? And am I going to make money from this? So those are the 2 higher level questions, and everything else is just like support to that. So what they're looking for in a more detailed way is they want to see that you have a clear business model. What is your product? What is the market? How is this, like, is there a product market fit? What is the opportunity? How are the financials? They want to see who's leading charge there, who would, like, do you guys have an experienced management team? If not, do you guys have, the advisors or a board or anybody that can help bring this product or this company forward, what you're gonna do with the money that they give you. So what is your use of funds plan? When you do get XYZ, I'm gonna spend it on, client acquisition, I'm gonna spend on marketing, I'm gonna do this, build out the product, research and development, whatever that is. If there is an exit strategy, either to get purchased or to continue to grow, there's no exit for the foreseeable future. And the last part is like, repayment ability. Like, are they going to get their money back or not? So those are kind of some of the higher level things that I think that they're looking for. And there could be others, like depending on your product or what it's doing, I guess, for the community and whatnot. And then kind of to put it all together, your funding presentation or deck, that's kind of things that we kind of previously already mentioned. It should be pretty easy to follow. This is your product, this is your business plan. If it's not your first year of operations, like here's my financial statements. If it is or not, you should have your financial projections. Here's where I kind of see the business going. This is how we're going to get there. Here's some of the risks. Like I've done the market research and whatnot, the management team. And then here's our funding requirements. This is how much we need, and this is what we're going to do with it. And with that, this is how it's, the company would progress. So that would pretty much be a good, call it business plan or financial deck. And yeah, that's pretty much on a high level, everything that I put together for this. So just open the floor to any questions or.
Awesome. Thank you so much for that, Alvin. There are a couple of questions in the chat. Sorry, let me just go back to them. This was regarding the balance sheet. So what would the removal of capital assets from the balance sheet look like if they were removed by a year end?
You would take it from the balance sheet, put it onto the P&L as an expense, and get rid of it that year. For example, okay, so actually there's two things. If you're getting rid of it slowly, like you're depreciating the asset, and let's say you have equipment for $5,000 on the balance sheet, you depreciate over 5 years. So every year you take out 1,000 and it goes into your expense line item through your P&L and it washes over 5 years. If somehow you just got rid of it altogether, you just take the whole 5,000, put on the P&L as expense, and you just get rid of it. It just kind of washes off.
Awesome, thanks. And then Silvana wants to know, do you have any suggestions for affordable or free online invoices?
To free online invoices?
Yeah, I think to create invoices. Christine recommended Wave.
Yeah, I would check Wave because Wave has a full a full free accounting thing. So as part of it, you can create invoices for sure. But if not, then you would probably download templates for it and then kind of update it. I think the only thing I would say is just make sure that your invoice numbers are sequential. It's much easier to follow back and not duplicate in that sense if you did do it manually. But yeah, check Wave.
Sounds good. Awesome. So we're gonna open the floor for questions. If you have any questions for Alvin, just feel free to just unmute and ask your question. So everybody's feeling shy, or we've got all our finances sorted out. We need absolutely no help. Alvin, if first, oh, there's a question in the chat. Follow up to the capital asset removal using the P&L. Does anything happen on the balance on the equity side?
Yes. So the beauty of the financial statements is it's always kind of linked. So how it goes is you'll take it out from the balance sheet. So you reduce the asset, it goes in the P&L as an expense. And then by default, it reduces your net income. And that net income is the item that goes back into your equity. And that's the circle. So you're essentially reducing the same $5,000 from your asset line, from your equity line, but it flows through the P&L. So it won't be like a one-to-one because there's other things on your P&L, but if it was one-to-one, actually it wouldn't be one-to-one because then you would pay less taxes that year for that $5,000, but it goes back into your retained earnings or accumulated loss. So it'll go into that line item. But if you use QuickBooks or Xero, it would do that for you. But that's how you would follow it through.
Alvin, I have a question for you. So, towards the end of the presentation, you'd mentioned how investors are looking for multiple things when they're looking to invest in a particular venture, and financial health is one key element that they look at. How much detail do they go into? Is it just your financial projections, your pricing structures?
Yeah, so the financial projections is really, on a number sense, your way to tell your story, right? Everybody's going to make it look pretty. It's their job to kind of see through the noise and ask questions like, is this reasonable? Or does this make sense? An example is if your revenue line just grows and grows, and your salaries lines does not grow, they'll be like, hey, do you not need more people to 10x your company? Or if you're selling a product, like your cost of sales line should probably, match with that. Or how are you going to 10x this without, increasing your product or increasing, different markets and whatnot. It just kind of has to make sense. And then how much detail they'll ask for is, usually they'll ask you for your financial statements if you have them. Usually you would have filed taxes for like maybe a year or two by then. They would just ask you for that. But they really just care more about the future because they know you're probably not making money or not making a lot of money, or else you wouldn't be in front of them. Like the future is where the story is at.
Got it. Gurmahir, sorry, I saw you unmute yourself. So.
Yeah. Yes, I actually have a question as well. Great presentation, by the way, Alvin. My question was that as a startup, is there an ideal way for startups to sort of save money when they're paying themselves? So let's say a company, which is two founders, they have two options to pay themselves: either write themselves a check and write it off as a salary payment, or pay themselves a dividend. Is there an ideal ratio that they should pay this much in dividends, this much in salary, to sort of save themselves any money?
Not really. It's kind of dependent on your personal tax situation of whether it's better to get a salary or a dividend. If your company is not making money, there's probably not much dividends to divide at the end of it. It depends on your personal situation. If you need kind of a stability and hey, I need X amount in my bank every month because I have, personal obligations, it's better to kind of be on salary on payroll. If you don't have that, then yes, you can kind of accrue it or just wait for dividends to happen.
Okay, got it. Thank you.
Emily, go ahead.
Hey, Alvin. Hi, thank you for the presentation. Well, for me and my partner, we're preparing to open a private school. But in the meantime, we are not really sure if we want to operate as the profit or non-profit. And we're just wondering, in terms of money, so money-wise, what are the pros and the cons?
That I don't know. That I actually don't know. I know you have to register for to be a charitable organization. It's a separate process, but that I actually don't know.
Oh, okay. Thank you.